In this lecture, we're going to learn about some great tax shelters that will let you keep more of your earnings on stocks. First, we'll look at individual retirement accounts, or IRAs for short. Then we'll turn our attention to 401k plans. Traditional IRAs have been around since the Employee Retirement Income Security Act, better known as ERISA, in 1974. You'll see that these accounts are among the most powerful investing tools at your disposal. Tax shelters aren't just for the big boys. According to the Investment Company Institute, an IRA is a trust or custodial account set up in the United States for the exclusive benefit of an individual or an individual's beneficiaries. That definition is fine for technically minded folks, but I like to think of an IRA as just a special label that we stick on investments. What's special is that the investments with this label, including stocks, get a tax break. The same goes for a specific type of an IRA, a Roth IRA, or a 401k account for that matter. You can put your IRA label on most of the stuff you typically hold, including stocks, bonds, mutual funds, and exchange-traded funds, more commonly known as ETFs. If you do put those assets in your IRA, then they'll earn the same return they'd earn outside of the IRA, except for one big difference. The assets in the IRA or 401k have major tax advantages. Investors around the world have a saying, it's not what you earn that matters, it's what you keep. IRAs let you keep lots more of your investment returns. You just need to take a little time to learn a few details, and then it's simply a matter of taking action. We'll learn about two types of IRAs. First, there's the traditional IRA. More recently, Senator William Roth of Delaware sponsored legislation establishing what are commonly called Roth IRAs in 1997. The main difference is when you get your tax break. With a traditional IRA, you get your tax break up front. If you invest $5,000 in a traditional IRA and comply with some IRS rules, you get to deduct $5,000 from your taxable income. Instead of reporting taxable income of, say, $50,000, you only report $45,000. If your marginal tax rate, that's the rate you'd pay on that $5,000, is 25%, which is what a single taxpayer would have paid on that amount of income in 2013, then you're going to save yourself $1,250 on your tax bill that year. The tax break on a Roth IRA is different. It doesn't come up front in the form of a tax deduction. Instead, the funds you place in a Roth get taxed, but then, subject to some IRS rules, your earnings on that investment will be tax-free. Yes, I said tax-free. If you invest $5,000 in a Roth and 10 years later your investment is worth $15,000, then you've just earned $10,000 tax-free. As much as I love IRAs, there's no free lunch. Congress authorized IRAs to ease the tax burden on your retirement savings. You're not supposed to use your IRA to save for a vacation, for example. Congress imposed penalties for withdrawing funds from your IRA before you're old enough to satisfy the law. Also, you can only contribute so much to either a traditional or Roth IRA each year. We'll get to those details later. IRAs are a terrific way to improve your investment returns. Suppose you and your best friend forever, Megan, each decide to allocate $750 a year to your investments. Let's say that both of your tax rates are 25% and that you earn 6% before taxes. The only difference is that you put your $750 into a Roth IRA and Megan puts hers into a taxable account, like a bank account or a CD. Every year for 30 years, you both do exactly the same thing. Do you both have the same amount of money in 30 years? The answer is a resounding no. It's not even close. Your investment of $750 in your Roth account each year has turned into almost $63,000. $62,851 to be precise. Meanwhile, poor Megan's investments of the exact same amounts, made at the exact same time, at the exact same assets, are worth only $47,814. That's a difference of over $15,000, or about 25% less. That's no coincidence. Remember what your tax rate is? It's 25%. That makes sense when you think about it. Megan is earning 25% less because the government takes 25%, so she's left with about 25% less when all is said and done. How much would you have had if you had invested in a traditional IRA, the kind that lets you deduct your contribution from taxable income on that year's tax return, but then has the total investment subject to income taxes at withdrawal? It turns out that it's exactly the same as the Roth IRA. If the tax rates during the accumulation phase are the same as at withdrawal, then a Roth and a traditional IRA yield the same amount. That's because the upfront tax deduction on the traditional IRA offsets the tax exemption on the Roth's earnings. The two types of IRA won't deliver the same amount if tax rates on the funds you invest differ from the ones in effect at withdrawal. If the tax rates are lower while you're withdrawing, then the traditional IRA will be worth more. And if the tax rates are lower when you're saving, then the Roth will be worth more. When comparing a Roth IRA with a traditional IRA, you want to take the tax hit when it will cost you the least. Just about anyone can open a traditional IRA. You just have to have earned income during the tax year of the contribution, and you must be less than 70 and a half years old by the end of the year. To the IRS, earned income is stuff like wages, salary, fees, commissions, and for the most part, self-employment income. Investment income doesn't count. You run into some income restrictions that limit the tax advantages of IRAs, though, and we'll talk about those in a minute. The eligibility rules are a bit different for a Roth IRA. The biggest difference is that if you exceed the income limits, then you can't make a contribution directly to a Roth account at all. We'll learn a way around that later, though. Rest assured that when you open your IRA, you won't be alone. The Investment Company Institute says that at the end of 2010, IRAs held total assets worth $4.7 trillion. That's just under 10% of U.S. households' total financial assets. That $4.7 trillion was more than a quarter of all U.S. retirement assets. Almost 50 million U.S. households owned at least one IRA at the time of the survey. That was over 41% of U.S. households. You'll have a lot of company when you open your IRA. You don't need to have a bunch of money to open an IRA either. Lots of those $4.7 trillion worth of accounts are small. The Investment Company Institute says that accounts held by investors between the ages of 25 and 29 averaged just over $8,000 at year-end 2007. That's not an annual contribution, mind you. That's the total account value. People between the ages of 70 and 74 hold the biggest IRAs, but even those average just over $162,000. Once you've opened your account, you fund it with cash, a check or an electronic transfer, for example. You can't put stocks directly into your IRA. Of course, once you've made your contribution, then you can use it to buy other investments, including stocks. People invest the biggest chunk of IRA assets in equities and equity mutual funds. For example, traditional IRA investors had 57.8% of their IRA assets invested in individual stocks, equity mutual funds, and equity exchange-traded funds at the end of 2007. Mutual funds were managing almost half of all IRA assets at the time, 48%. Traditional IRAs and Roth IRAs are great investment tools, but you do need to pay attention to a few details. IRAs, like all tax shelters, have rules you have to follow. They aren't very hard, but they do change now and again. They boil down to income restrictions, contribution limits, and withdrawal terms. For a traditional IRA, the income restrictions are pretty messy. They depend on whether you're covered by an employee retirement plan, such as a 401k, and whether you file as a single or married taxpayer. What's more, these income limits can and do change almost every year. For example, if you filed your taxes as married filing jointly in 2006, then the income limit for deducting your entire contribution was $75,000. At that point, the deductibility began to phase out until it vanished completely at $85,000. By 2013, the income limits had increased to $95,000 and $115,000. If your filing status is single, then those limits tended to be about 30% or 40% lower. Those income limits apply to what the IRS calls modified adjusted gross income. Your modified adjusted gross income comes from a line on your tax return. Essentially, it consists of money you've earned as wages, tips, salaries, bonuses, and the like. For a Roth in 2011, the income limits were $107,000 for people who filed as single, head of household, or married filing separately. Above that, the contribution limits begin to bite. The IRS reduces the allowable contribution as your income increases, and above $122,000, direct contributions to a Roth account were forbidden. For those filing jointly, the limits were about $50,000 higher. Roth limits can change too, so be sure you check before you make your contribution. Contribution limits tend to creep up with time too. In 2012, your combined contributions to your traditional and Roth IRAs couldn't exceed $5,000. By 2013, they were up to $5,500. There's a catch-up provision too. If you're 50 or more, then you can sock away an extra $1,000. For most people, the tax saving on that kind of investment can be pretty big over time. Remember the example we did earlier today? The tax saving on an annual contribution of just $750 was about $15,000 over 30 years. There are also time limits. I think of them as windows of opportunity. People whose tax year matches the calendar year, that's most of us, can make their Roth contributions any time from the beginning of the tax year through April 15th. Once the deadline for filing your taxes passes, though, you're out of luck. Even filing for an extension on your taxes won't let you dodge this restriction. When you withdraw your money from your IRA, you're taking a distribution. With a traditional IRA, you defer taxes until you withdraw the money. The rules for distribution depend on your age. If you're less than 59 and a half years old, then you'll pay the federal and state taxes, of course, but you'll also pay a 10% penalty. You can avoid the penalty on early distributions under certain circumstances. For example, first-time home buyers are usually okay up to a limit of $10,000, as are certain education expenses. Disability or death allows you or your heirs to tap the funds without penalty, as do unreimbursed medical expenses. Withdrawal rules for traditional IRAs get easier after you turn 59 and a half. You won't pay a penalty when you take a distribution. You'll pay federal and state taxes if you do, of course. You only get your tax break on the front end of a traditional IRA. Qualified distributions from a Roth IRA are simpler. With a Roth, you want to remember two numbers when it comes time to withdraw your funds. The first number is 5. That's the number of years it takes to season an account, making it eligible for favorable distribution rules covering Roths. That's a powerful incentive to open your Roth soon, even if you just invest $100. Get a start on that seasoning period as soon as you can. The second number is 59 and a half. That's the age when you can begin to withdraw funds from a seasoned Roth with no restrictions. As with a traditional IRA, other ways to avoid penalties are death, disability, and being a first-time home buyer. The exemption for withdrawing funds to buy your first home is another powerful incentive to start your IRA immediately. Suppose your son Daniel's first real job is herding shopping carts in the parking lot of the local grocery store at the age of 15. He might not make much, but for starting an IRA, that's fine. Have him open an IRA account, no matter how small. He'll have access to the full account value up to the $10,000 lifetime homebuyer limit if he decides to buy a house. It probably won't be a large sum if he taps the account soon, but by the time he's, say, 30, that won't be the case. You'll get hit with taxes on your earnings and a 10% penalty if you don't meet those withdrawal criteria. But notice I said earnings. Yes, you'll get hit pretty hard if you withdraw earnings, but you can remove contributions from your Roth IRA without penalty. That's another big loophole in the withdrawal restrictions. Roth accounts can be great estate planning tools. If you die before you withdraw all of your Roth funds, then your heirs can withdraw the money over their expected lifetimes. They don't have to take it all immediately if they don't want to do that. Whatever assets your heirs leave in the account continue to grow tax-free. You can even tap funds temporarily if you have a short-term cash need. You can withdraw funds from your Roth for any reason and repay those withdrawn funds within 60 days with no penalty. Repaying the contribution lets you continue to have a bigger pile of cash working for you tax-free. You don't need to rebuild your Roth a little at a time over the years. Before 2010, if you made more than the income limits, then you couldn't deduct your contribution to your traditional IRA, and you couldn't contribute to a Roth at all. You were just out of luck. Since 2010, though, you can fund your Roth through the back door in just 2 steps. In the first step, you contribute funds to a traditional IRA. Because of the income limits, you can't deduct your contribution. But then comes the second step. You just convert that traditional IRA into a Roth IRA and pay the taxes on the converted value because, as we saw earlier, Roth IRAs must be funded with after-tax dollars. Voila! You made a perfectly legal Roth contribution despite being over the contribution limit. Your broker or mutual fund company should be able to handle all of this for you with, at most, a couple of phone calls. Being able to convert from one type of IRA to another is especially valuable to people whose income fluctuates. Suppose you're not sure whether you qualify for a fully deductible traditional IRA. Maybe you want to fund a traditional IRA if you can deduct the contribution, but if not, then you want to fund a Roth IRA. What can you do in this case? The best thing to do is fund one or the other by the initial filing deadline, usually April 15th, and then revisit your decision no later than the end of the extended deadline, which is usually October 15th. That's because the IRS lets you recharacterize an IRA contribution. You can convert a traditional IRA contribution to a Roth contribution, or you can convert your Roth contribution to a traditional IRA contribution. You can also convert an existing traditional IRA to a Roth. You'll incur a tax liability if you do that, though. Say you have $40,000 in a traditional IRA. You can convert that to a Roth, but you'll have to add $40,000 to your taxable income that year. If you're in the 25% marginal tax bracket, then you'll have to come up with $10,000 more in taxes. Generally, you don't want to do that. If you're going to have to reduce your IRA contributions in the year of the conversion to cover that $10,000, then it's probably a bad idea to convert in the first place. Having $30,000 in a Roth is probably not as good as having $40,000 in a traditional IRA. The best time to convert a traditional IRA into a Roth is if you have a year with unusually low income. Maybe you're self-employed and just had a bad year, or took a long vacation that cut into your working hours. Maybe you had a baby and decided to work part-time. That would be a good year to convert your traditional IRA into a Roth because you'll have lower taxable income and the tax bite will be less. When your business returns to normal or you return to work full-time, your tax rate will go up again, but that won't affect your Roth. You might be wondering which type of IRA is right for you. Traditional IRAs are still the most common type of IRA. I think there are two reasons for that. First, Congress authorized traditional IRAs almost 25 years before it authorized Roths. That's a big head start. Second, based on just expected tax rates, most investment advisors recommend the traditional IRA over the Roth, assuming that you qualify for both. The idea is that you'll withdraw the funds after you retire when your income is lower. That should translate into lower tax rates for most people. That makes sense if, and it's a big if, tax rates stay about the same as they are now. You can make a good case that's not going to happen. People look at the growth in U.S. government debt and wonder how the federal government can possibly repay its obligations. In 1966, for example, the federal debt was about $320 billion. 10 years later, it was a little less than double that, or about $600 billion. 10 more years, and it had more than tripled to almost $2 trillion. 10 more years, and we're at $5 trillion. Just from 2009 through 2013, the federal debt increased about 50%, and there's no real sign of the explosion in federal debt slowing down very much, let alone declining. Expressed as a percentage of gross domestic product, or GDP, the picture is a little better, but far from reassuring. Looking at evidence like this, many people believe that taxes are going up, perhaps a lot. If they're right, then your taxes could be higher at retirement than they are now, even if your income is lower. I don't pretend to know what your taxes are going to be when you begin to withdraw funds from your IRA. From a tax perspective, it wouldn't hurt to have both types of accounts. Your Roth IRA will pay off handsomely if tax rates rise because you paid the taxes up front. Your traditional IRA will pay off if they don't rise because you'll pay the taxes at withdrawal. You're ultimately going to be guessing on those tax rates. Good luck. But don't miss the forest for the trees. Regardless of what happens to tax rates, either type of account will be a fully taxable account. A traditional IRA avoids taxes on the contributions up front. A Roth avoids them on the earnings down the road. But you pay the taxes on both with a taxable account. Even if you pick the wrong type of IRA, you've done yourself a favor by starting one. You might not be quite as far ahead as you would have been if you made the right choice, but even the wrong choice puts you ahead of where you'd have been with a taxable account. By way of comparison, Canadian citizens have access to something quite similar to a Roth IRA. That's the tax-free savings account, or TFSA for short. Contributions to a TFSA don't generate a tax deduction, but earnings are tax-free. Just like a Roth, Canadians can put stocks and mutual funds in the TFSA. Annual limits are about the same too. The TFSA has one big advantage over the Roth though. If you don't fully fund your TFSA in 1 year, then the unused amount carries forward. You can make it up the next year. U.S. citizens can't do that with a Roth. In the United Kingdom, the closest thing to an IRA is a self-invested personal pension, or a SIP. Like an IRA, a SIP is essentially just a label you attach to retirement investments. UK citizens get a tax break on contributions, but lose access to their funds until certain requirements, mostly related to age, are met. Many U.S. companies offer their employees 401k retirement plans. A 401k retirement plan works a lot like a traditional IRA. Participants' contributions don't count as taxable income in the year received. Both the investment and the investment earnings get taxed at withdrawal, but from the time of investment until withdrawal, nothing is taxed. Just like in an IRA, you build a much bigger nest egg than you would in a fully taxable account in almost all cases. 401k plans have been gradually replacing pensions as the primary source of retirement income in the United States for several years. 401k plans were authorized by Congress in 1991. Want to guess why we call these plans 401ks? Yes, Section 401k of the IRS Code contains the language that describes it. Collectively, 401k accounts are huge. According to the Investment Company Institute, 401k assets were $1.6 trillion in 2002. That was about 15% of the U.S. retirement market in 2002. By September 30th, 2012, 401k assets had climbed to about $3.5 trillion, or about 18% of the U.S. retirement market. But these are not all huge accounts. The average account balance was $58,991 by the end of 2011. Given that IRAs and 401ks are pretty similar, you might expect that the investment allocations for the two are also pretty similar. You'd be right. Stock mutual funds are the most popular choice, with about 40% of 401k investments in that category. By the time you add stock mutual funds, the equity portion of balanced funds, and the employer and company stock, you'll find that 401k owners had just over 60% of their funds invested in stocks at the end of 2011. It makes more sense to put an investment that gets taxed heavily in your tax shelters. If you decide that stocks are your choice, then it makes sense to put high dividend stocks in your IRA or 401k and keep low dividend stocks outside. There's some evidence that high dividend stocks offer higher expected returns before taxes than low dividend stocks. The reason is that dividends get taxed more heavily than capital gains, so high dividend stocks have to pay more before taxes to make them fair deals after taxes. If you decide to put stocks in your tax shelters, then fill your IRA or 401k with your high dividend stocks and keep your low dividend stocks in a regular account. This runs counter to the advice you'll get from some other sources. Some people think that because your IRA or 401k investments are long-term, you can afford to put risky stocks, which tend to be low dividend stocks, in them, because the variation of your return evens out over time. But we learned in Lecture 4 that this argument is simply wrong. The longer you stay in the market, the more risk you bear, not less. Remember, the range of potential rates of return narrows over time, yes, but the range of potential payoffs in dollars doesn't. The longer you're in the market, the bigger the potential gains and losses in dollar terms. And you didn't need Lecture 4 to know that you buy things with dollars, not rates of return. The best thing about 401ks, or at least some 401k plans, is the employer match. An employer match is just what you think it is. Your employer matches your contributions. Not every plan offers an employer match, but it's great for employees of plans that do. Usually, the company only matches a relatively small amount, maybe 2 or 3% of your salary. But if you make $100,000 a year and your company matches 401k contributions at 2%, then if you deposit, say, $2,000, the company will kick in another $2,000. Where else are you going to get an immediate 100% return on your investments? The IRS limits employer matching contributions, usually to around 6% of an employee's salary annually. You'll also face an annual contribution limit, just like with an IRA. The employer's contribution doesn't count toward that annual limit. For example, you can make the maximum 401k contribution of $17,500 in 2013, and if your employer matched the first 4%, then that match would be deposited in your 401k account in addition to your contributions. Not all 401k matches are dollar for dollar. Lots of matching plans match 50 cents per dollar. That's still worth grabbing. Where else will you get an annual return of 50% on your investments with almost no risk? Most 401k plans don't vest all contributions immediately. That means that some employers don't allow workers to keep any of the 401k matching funds until they've been with the company for a set number of years. For example, about 1 in 10 employers fully vest participants in the plan after 3 years of service. If workers leave before that, then they don't get to keep any of the match. You're going to face the same sort of early withdrawal penalties on your 401k as you will on your IRA. We won't get into that because they're much the same as for your IRA. Consult a tax expert if you need the details. Many companies allow employees to buy company stock for their 401k plans at a discount. That sounds deliciously tempting, doesn't it? Who wouldn't want to buy, say, $1,000 worth of stock for $800? I certainly would, subject to an important caveat. I don't want to hold too much of any one stock, especially my employer's stock. I want to stay diversified. That counts double for the stock of the company that pays me, because I don't want my job and my investments to collapse at the same time. The best strategy is probably to buy as much of the discounted stock as you can, but sell most of it as soon as you can. Reinvest the proceeds in some other asset so that you don't have all of your eggs in one basket. All investment vehicles are subject to the rules laid down by the government and agencies like the IRS. Unfortunately, the government can change these rules whenever it wants. That means that if you like the sound of these investment vehicles, then you're not quite home free. You'll need to check to make sure that the rules in force at that time still work to your advantage. Of course, that's true for any investment. We can't avoid this risk. It's just the way life and the government work. In our next lecture, we'll be studying initial public offerings of stock, or IPOs for short. If you want the executive summary, it's simply this: all bets are off.